It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to another episode of the Real Estate Breakfast, talking your property news 7 days a week. And you can catch us on iHeartRadio, Spotify, Apple Podcasts and Amazon. The middle of our working week up to a Wednesday, October the 23rd. And if money is tight for you right now to making those mortgage repayments, and I should really take out the word if out of that comment, because of course money is tight, which is why some people have arrears in their repayments. Well, it's not all bad. Interestingly, the RBA's Financial Stability Review does offer up some key insights into mortgage arrears, which have been rising since late 2022, but less than 1% of all owner-occupier loans are 90 plus days behind on their repayments. Of course, that is little comfort if you are sitting in that 1% range, because for you, it is bad. And the highest risk loans, those with a loan to valuation ratio of over 80%, have arrears slightly above 2%. And first-time home buyers are doing reasonably well with arrears below the 1% mark. That whole feared fixed rate cliff, this seems to have been managed. And I, for one, was not predicting that a year ago, along with some economists' concerns that the rate cliff might materialise. But no, we seem to have managed to navigate our way out of that problem. So let's this morning catch up with Eliza Owen from CoreLogic, who is the head of research there. And good morning to you, Eliza. Welcome back to the Real Estate Breakfast. As I say, there seems to be a bit of navigating our way out of that rate cliff.
Yeah, good morning. Thanks for having me. When we look at arrears data, as you say, the portion of home loans that are actually seeing late payments remains very, very low, but it is rising. Overall, the portion of home loans where payments are more than 90 days past due, or what we would call non-performing loans, is sitting at just 1% of outstanding loans. That has generally risen since the start of interest rate rises. In June 2022, that arrears rate was just 0.76%. But I guess this just goes to show those kind of unquestionably strong standards in lending that the financial regulator, APRA, has been trying to achieve, where even when we go through this massive period of adjustment of rising interest rates and Australians being relatively indebted, that the arrears rate is still so contained at 1% overall.
Yeah, it's a barometer to watch for sure. Now, the federal government's National Housing Accord, that, of course, is aiming to deliver 240,000 new homes annually, equating to about 20,000 homes each month, starting from July of 2024 this year. But 2 months into the National Housing Accord, the federal government has yet to meet a single target, and that is according to the Institute of Public Affairs. It is a problem. It's one to keep an eye on, but what are your thoughts on that?
Yeah, absolutely. So we get monthly dwelling approvals data coming through from the ABS, which is a really good indicator of how the government is tracking against this goal, because we really should be seeing something like 20,000 dwelling approvals flow through per month. Instead, we're seeing about 14,000 a month. That's been the average total dwelling approvals across Australia for the past 6 months. There's been a modest uptick in the number of detached house approvals, which seem to have bottomed out in January this year, but we're still nowhere near the amount of dwellings that we need to meet that 1.2 million target over the next 5 years. And unfortunately, the economic environment is really working against them. you've still got relatively high interest rates. There's not a lot of feasibility because of high land costs, high construction costs, a shortage of construction labour. And these are things that are going to take a really long time to unwind. Whereas historically, building booms have been supported by essentially a lot of investor interest in the market and the kind of off-the-plan apartment boom of the late 2010s. We are still seeing a rise in investor interest in Australia's market, but it's not under the same kind of conditions as what we saw in the 2010s. So I think there's a real challenge ahead. And just talking to people who work in the construction and residential development sector, they think 2025 in terms of volume is going to be one of the toughest years yet for completions.
Yes, exactly right. And we are talking with Eliza Owen this morning on our Wednesday. We'll come back with more after this.
Every week, real estate transactions take place as the market shifts month by month. And every day, we keep you better informed and updated on the Real Estate Podcast. It's time to go back to the Real Estate Vault for this week's property comment.
Interest rates are not the sole factor driving and influencing housing prices. There are many other factors that influence it, things like tax settings, banking regulation. And, that's a great example because the last downturn, was really constructed. It was a structural downturn as a result of APRA changing lending conditions. Other things that influence house pricing is population and income growth, but also the responsiveness of new housing to supply to the growing demand.
And right now it is time for another 30-second property tip. And we are going to the ACT to Jeremy in Canberra. Good morning, Jeremy. What have you got for us this morning?
Thanks, Craig. For buyers, I think at any open house, we always get version of the question from a buyer is how much do the owners want, which is completely valid, but sometimes a little bit hard to answer. So I think just asking the question a little bit differently, if you are a buyer and you do like the particular property, simply ask, what's a price that would secure this property for me today?
We talk to the most knowledgeable real estate experts across Australia every day from 6 a.m.
And it's your Real Estate Wednesday. We are talking to Eliza Owen from CoreLogic this morning. A couple of weeks ago, we were talking about these new $1 million suburbs. In particular, Brisbane alone, we saw 46 suburbs across their median household unit values rise above the $1 million mark over the past year. And also similarly, Perth with 36 new $1 million suburbs. I mean, it's just phenomenal because it's not like it's one or two of these suburbs suddenly that find themselves in the $1 million range, but, 46 for Brisbane and 39 for Perth.
Yeah, it's pretty extraordinary, and it's definitely a reflection of the sharp increase in value that have been seen across cities like Brisbane and Perth over the past few years. It relates to things like strong migration trends coupled with undersupply, so what we were just talking about with the constraints in the construction space. And that's really seen, I think, the values pushing higher and higher. Not only that, but I think through the pandemic period, a lot of people started to look at the lifestyle appeal of Southeast Queensland more broadly. Perth has become a lot more feasible in terms of jobs and population growth because it's also caught up in that upswing for the commodities sector and resources sector as well. So, it represents an absolute transformation of these markets. And nationally, the number of suburbs with $1 million median is at a record high.
Yes, and let's have a look at rental growth, which has eased significantly, which we've talked about here on the Real Estate Breakfast, with a minimal 0.1% increase over the quarter. It is making the weakest rental growth in 4 years. It does signal increasing pressures across both the buying and the rental market. So any thoughts on those numbers?
Yeah, so essentially this signifies the end of the rental boom that we've seen over the past 4 years. And that's very much being driven by changes in the demand side of the rental market. we've passed a peak in net overseas migration, which was back in March of 2023, playing catch up from closed borders through COVID. And we're also at a point now where we're finally starting to see a consistent lift in average household size. So even if there's no change to your population, average household size determines how the existing population utilizes housing stock. If you have more people per dwelling, which we're starting to see now in the rental market with resurgence of share housing, then that fundamentally lowers the amount of dwellings that you need to accommodate people. And that's where we're starting to see rent growth tap out. So it represents a challenge to rental affordability because people are having to go back to share housing where they just can't continue to shovel out more and more of their income for rental values.
And lastly, I did mention, of course, the year starting to run out on us. 2025, some of the economists are saying, hang on, there might be a bit of a boom in the market. We've got those rates and a few of them in the forecast for 2025 to come back. What are your thoughts? Here we go again. It's prediction time.
So what we're thinking is that the rate cutting cycle is probably going to start in the first quarter of next year. And that's just based on the consensus of the major bank forecasts for the cash rate. However, the expectation is that it's going to be a pretty shallow rate cutting cycle. Remember, we came from 0.1% in early 2022 to now 4.35%. The expectation is that by the end of next year, the cash rate could sit somewhere between 3.6% and 3.1%. So we're not going back to those historic COVID lows that induced the housing boom through 2021. Instead, I think this could provide maybe a modest uplift to demand. Affordability remains a massive constraint. We're not getting a lot of new dwelling supply from a construction perspective. And even where we have seen an increase in household incomes, because of the introduction of the stage 3 tax cuts from July, we haven't really seen the market react to that. So that signals to me that the first rate cut might not do much for housing demand next year.
I think we'll probably have something to talk about, though, in 2025. What do you think?
Oh, yeah. I think it's going to be a really interesting landscape once rates start coming down. And it's a key consideration, particularly for the RBA and the Council of Financial Regulators, whether that reduction in interest rates starts to reinflate debt levels. That's going to be something that they'll be considering from a prudential perspective as well.
Always a pleasure, Eliza, and enjoy your Monday. As I say, we are looking forward to 2025 for all sorts of different reasons. Enjoy your Monday. Look forward to catching you back soon.
Thank you. You too. Thanks for having me.
Gain insights with exclusive conversations from real estate professionals about buying, selling and investing across Australia.
I started selling on the 1st of January, all my properties this year, by the open platform, which has made a huge difference, and the buyers have loved it because it gives them full transparency. I wind the campaigns up within 10 days.
Once people start looking at property, it might not have been like, oh, we don't really want to go there, but the prices are cheaper. But then once they get there, they start experiencing the area. Do you see that there's a bit of a change in mindset?
Very much believe that. We are pretty competitively priced compared to Sydney. A lot of buyers, look, I'm selling probably 75 to 80% of our buyers are from the Sydney metro area. So a lot of people looking for that tree change, that lifestyle, slow down, and also that the changeover of perhaps drop a big mortgage in Sydney and come up here in a smaller one, which is a very attractive option.
We connect you to the best real estate information across Australia. The Real Estate Podcast.